Well, good evening, everyone. Welcome back to the channel. Happy March 1st. Hard to believe we're already into the third month of the year. And today we're going to continue the series that I started about retiring with $1 million in a given dividend ETF. Now, what I want to say, because I've gotten some feedback that, $1 million uh, may be an amount that not everyone has, which I understand, but I picked this example because obviously it gets a lot of views on here. And for one thing, I mean, the number gets attention, but the math is also easier because it's simple. I mean, a million is one and then six zeros. So, but to make it simpler, I mean, you could take a zero off and make it 100,000 or whatever amount. So, and I'll do other videos where I make it a different amount. I just want to see, I want to keep this going right now because the first couple of videos I did on this topic got a lot of views. So you know, that's the goal as a YouTuber. But anyway, with that being said, today I'm going to discuss the TLTW fund, which I didn't know much about until I had a few commenters point it out and ask for my thoughts on it. And once I looked into it, I thought it was actually really good, even though it's a bond fund. I mean, I think the total dividend's like 21%. So let's look at it real quick. I'm going to share Yahoo Finance here. And assuming that all the information there is correct, which sometimes we know that it's not. Okay, so the iShares 20+ year Treasury Bond Buy Right Strategy ETF closed today at $32.91, which was down almost a percentage point, 0.75 to be exact. We don't have any information for after hours. The market's been dropping again, which, we had a great first month of the year, but so far since the first month of the year, it looks like we're kind of back to how things were in 2022. But we still got a long way to go. Hopefully we can finish up this year. So let's see. This fund has been around since August 2022. It was as high as $40 a share, but it's dropped as low as 32, 38. So it's pretty close to its low point. But what I want to show here, the dividend, just so we understand before I do the spreadsheet, historical dividend, if I do this, let's see. Dividends only. So September, October, November, December. It paid twice in December, but the December 23rd one really would have been the January one. And we should be having one come up in March, like within the next day or two. So it's possible if you were to buy into this tomorrow, you could, if you get in before the dividend payout, it's possible you could get the dividend still. But anyway, this is a really solid dividend here for 6 months. We have 55 cents in September, 64 cents in October, 62 cents in November, 48 cents in December, and I'm rounding up a bit, or rounding down, I guess, but I'm adding these up to be exact. So $3.28 for 6 months. If I divide that by 6 months and then times it by 12, I get $6.57. $6.57, and we'll do all this in a spreadsheet in just a second, but 657 divided by 32.91 is almost 20%, which is phenomenal. So now let's go to our spreadsheet. Let me just do this to make it easier. I'm going to stop the share and then switch over to my other screen instead of going or pulling the spreadsheet up on the same screen. So here we go. Here it comes. Okay, so TLTW, which I have here, I started at the current price of $32.91. It's going to come up in currency. It's we'll just do this here, 30,386 shares. The dividend we said was, have it up here. Let me just look and see how I did this before. Okay, I put the whole amount. Actually, what I'm going to do, I already added it up, so I'm going to put the whole amount. Hang on here, $32.91. So it's $6.57 if we annualize it. And so we're in SVOL territory. This dividend is as good as SVOL, but if you look up here, SVOL is still cheaper. Let me see. I think I have it over here. SVOL, yeah, it's going to buy you more shares because it's cheaper. Wait a minute. SVOL 384. No, this is like a double what the SVOL dividend is. So let's see here. Oh, JEPI 623. Surprised I don't have our favorite one up here, but that's because this is the first one I did back in October. Which, by the way, since that was several months ago, I can probably just do it again. Okay, so our favorite number here is going to be number of shares times dividend. So if you were to invest $1 million in TLTW, however you came up with it, say you saved money your whole life, working, say this is your total life savings, say you sold your house, say you had two houses, say you just sold everything you had, pooled all your assets together, and you came up with $1 million. And if you want to make the example simpler, you can just shave off a zero and make it 100,000, right? But with $1 million, this is how much you would make in your annual payout: $199,636.02. So if you were to only say it was 100,000, then you would just take a zero off, right? So then instead of 199, it would be 19,900. But obviously, the more money you have, the better. Let me see something here. 3291. Yeah, so it'd be 20,000. So you're just basically shaving off a decimal, or you're moving the decimal point over. But anyway, I'm sticking to this for now. So, okay, what else did we do? Okay, that's the amount. Oh, let me just copy and paste this. I like to make this more interactive, so I just do it as I go. So copy this, paste it down here, and let's see. Okay. This one, I'm just taking this, dividing by 12. So this is how much per month. Look at that, almost $17,000 per month. That's phenomenal. Now, granted, there's only 6 months of sample data on this one, so it's not too robust as far as the sample data that we have. Let me move this up here. Copy, paste. Okay, so the low range of this fund, I said it's traded as low as $32 a share, and it's been as high as $40 a share. So we'll pick 32 and 40 is what we'll do. And I have 3 live viewers, but no comments yet. So feel free to comment. Feel free to super chat. That's also very welcome. But let's see. Okay, so in our scenario here, if it's, oh, no, this is the dividend. So if the dividend, what was our low point for the dividend? Let me go back to Yahoo here. Dividends only. Let's see. Okay, so the lowest dividend we got in the 6 months was actually in February, 46 cents. The highest dividend we got was 64 cents in October. And typically, like I say, with these ETFs, what I find is that the worse that the market does, the better the dividend payouts are, versus the better that the market does, the worse the payouts are. So that's why I say there seems to be an inverse correlation between the dividend payout and the performance of the market. So that's why sometimes they seem to work better in the down markets. Okay, so we're going to say if 46 cents, and then if 64 cents, I believe was what we said. 46 cents, 64 cents. Okay. Isn't this fun? Talking about making money, and oh, I lost one of you. Oh well. Anyway, we'll keep having fun here. Okay, so let's see here. So we're going to say what cell is this? G24. G24 times this over here. Oh, come on. G24 times, let me just do this, 46 cents. The worst case scenario, and then best case scenario, 30,000 shares times 64 cents. So the range here, you make between 14,000 a month and 19,000 a month. Now, getting to that 19,000 a month, I mean, that's phenomenal. You see what this projects at for the year. That's like a mid-level management pay just for being invested in this dividend. So, oh, and then the payout. Let me do this again. 657. Here's how we're going to determine this. Watch this. Um, it's $6.57 divided by 32.91, and we get an error. How about that? Let me do this. Oh, probably because I used currency. 291. So it's about 20%. It's about a 20% payout. And I don't know what the heck this number is here. Oh, but what we'll do, so we'll take this. This is the same, basically, if we take the $1 million. Come on. What happened here? Okay, if we take the $1 million, times it by this, we're going to get the same number we had here. Now, this is basically a rounding error. That's why there's like a dollar difference here. And then let's see what we had here. We'll delete these. Yeah, what I was doing here, basically compound interest. So what I say, if you can afford to sit on this for a couple of years, this is the same example that I like to do. Oh, wow, time's getting away from me here. Let's see. Okay, 11 minutes in. I'm just going to keep it going past midnight on the East Coast here. That's okay, though. What else did I want to say? Give me just a second here. Okay. So take $1 million, right? And then do this in year one. And then if you don't touch this at all and you just reinvest the dividend in year two, watch this. See how it starts to build? And then eventually the spreadsheet will follow our logic here. So look at that. In year three, if you keep it reinvesting a 20% dividend, you're going to compound fast to where in year five, you've doubled your money if you can afford to sit on this for 5 years. And then if these amounts above here weren't enough for you, you're really going to be rolling in the money now, because watch this. Your 19% payout on 2 million because you doubled your money. Hold on. That's how much you would get. Let's see. 0.1996. So now you've doubled your payout. If 200,000 wasn't enough, now you're at 400,000, 34,000 a month. I think that's enough to really live a nice lifestyle in retirement. I mean, some people would not even make what this would pay in a month in a whole year. So that's phenomenal. And then, second, divided by 12. And then per day, if you want to take per day, just say 31, $1,000 a day. How is that? That can buy a lot of stuff. But that's the power of compound interest in these funds. Now, the other scenario, which I'll do over here in column E. So say the fund, say you invested, you have your 30,000 shares, and then say the fund drops to like $25, because some of you pessimists out there like to focus on the worst case scenario. So then, you lost to almost 215,000, and you're down to 759,000. But if dividend stays equal, you're going to start to make it back pretty quick. So you'll go from this to this, you see, and then in year three, with that, when that dividend keeps on, you'll be back to where you were, and then you just keep on reinvesting it, and then boom, you get back to where you were pretty quick. And then just say the market, like I say, it's only down for maybe 2 out of 10 years. So if you take this and then divide by your shares here, hold on, trying to figure out, let's see, times 25. Just forget this. Say you didn't. Say you just took the cash dividend. Not that. 0.1996. So it would still pay you like 151,000. And say you just took that in cash and you just let it recover. So say in year 2, then say it comes back to like $28 and you're back to 850. But say, just for argument's sake, say you reinvested it. Say you had the 911,000, and then say the fund was at $28. You would have this many shares. But really, what you want to do, just let it keep compounding if you can, because chances are, those of you that are in this position, you probably paid into Social Security, and at bare minimum, you would get that anyway. And like I say, the audience that follows this channel, you all are very resourceful, entrepreneurial type people. So this isn't the one trick you have up your sleeve. You're probably doing multiple things. This is just one of many things. And I like to illustrate this to show how easy things can potentially be when you save a lot of money and you use the time value of money to your benefit. So now let's see here. Oh, a comment finally. Total return since inception is less than spectacular. However, passive income is fabulous unless one considers eventually the initial investment may substantially decrease. Yeah, that's exactly what I was saying there, Michael. So if the initial investment decreases, you're still going to get a pretty good payout because this is paying a solid dividend. So where the cursor is right here, you can see just in the worst case scenario here, saying it dropped from 32 to 25, you still have 760,000 of your initial investment, and then you let the 20% dividend kick in, and then in 2 years you've already recovered your money. And another thing you can do too, if this happens, you can take. Let's do this here. So forget these numbers. What you can do, dividend that you get even on this amount of money. Watch this. So you're going to take this minus this, and then your 151,000 you're going to buy back in at the $25. So then you're going to have 6,000 new shares on top of the, what did we say, 30, how many thousand? 30,386. Hope I'm not losing anybody here. I'm, kind of on a roll here with these numbers. So then 36,451, say you recover to like $28. Boom, you're back over $1 million just with that. Say the fund recovers completely. Say it gets back to like $32 within the year. Then watch this. You acquired more shares at a lower price because you dollar cost averaged, and then you're at 1.16 million. So you see how quick things can turn around if you just kind of stick to the strategy. So that's kind of my thought process there. That's what I'm looking at with that. As far as TLTW, it's kind of misleading because, for me, when I read bonds, I kind of just, my brain shuts off. But really, this fund is pretty good. And let me go back to Yahoo just to show, um, some basics about the fund again, because we're pretty much done with our spreadsheet analysis here. So looking at the fund again, it's called the iShares 20 plus year Treasury Bond Buy Right Strategy ETF. But like I'm showing here, the dividend that it's paying is really solid. Especially, I mean, you wouldn't expect it for a bond strategy ETF. But this is the performance of the fund, like I said, since August. And let me see here. TLTW. According to stockanalysis.com, TLTW has a dividend yield of 9.97% and paid $3.29 per share in the past year. See, the funny thing is, a site like this didn't do what I just did at the beginning of the video. They took half a year and multiplied it fully. What you've got to do, if you have 6 months of data, you've got to add up the 6 months and then basically times by 2 because you only had 6 months of dividend payouts. So let me see something here. So I'm at iShares.com. I'm not sharing the screen, but I'm just going to read off of this here. iShares by BlackRock, which BlackRock was supposed to have a really good year this year, rebuilding Ukraine and whatnot, from what I understood. Let's see. What's this telling me here? The expense ratio on this fund is 0.5%. Net expense ratio 0.35. Not too bad. And what does it tell us here? You know what? Let me just share this screen instead of Yahoo. How are we doing here? Okay, 4 viewers. Okay, I'm going to keep going. So I'm going to share the iShare screen. Let's see. Feel free to comment for those of you watching. Okay, so what the iShares.com is telling us, why TLTW, potential for enhanced income, may provide enhanced income compared to traditional U.S. Treasury bonds by selling monthly covered call options. So yeah, it's a covered call ETF. Diversification, which we don't really care about. This fund may outperform in periods of rising rates, which we've seen that it has so far. Easy access, convenient, and cost-effective single ticker access to a custom options overlay strategy on the U.S. Treasury. Investment objectives. The iShares 20-plus year Treasury bond buy right strategy ETF seeks to track the investment results of an index that reflects a strategy of holding the iShares 20-plus year Treasury bond ETF while writing 1 month covered call options to generate income. That's a mouthful there, but that's basically what it is. It's writing covered call options to generate income. So that's why, like I say, when the market drops, my theory again is that the covered calls expire. The ones that you sold to the buyer, they expire worthless, so you keep the whole premium. So that's why I think, and eventually someone will either correct me or I'll figure it out if it's wrong. That's why I think that the payouts on these funds are better when the market does worse. Here's growth of 10,000 distributions. I always like these charts here, the growth of 10,000, because it's a nice round number. We would actually be down if we had invested at the start, because it was at 40. So we would be down, but basically 1,000. But we can recover. I mean, this is only like 6 or 7 months in, so not too bad. Oh yeah, thank you. Yeah, I'm trying to coach everybody up here. Um, anyway, so I think I've covered this one pretty good. If you all like that, please remember to like, comment, and subscribe. Even if you didn't, same deal. And I'll try to keep churning these out daily. These have been doing really well. So the month of March, it'd be nice if I could try to get daily videos out and keep an eye out for the next podcast too. We were supposed to do that today, but that was my fault. I wasn't ready for it, but we should do it tomorrow. So thanks everyone for tuning in. Have a good evening. Take care.